Hello, everyone. Welcome once again to one more episode of ForwardPreneurs, where resilience, innovation, and knowledge meets entrepreneurship and leadership. I'm your host, Susana Fortes, and today I'm super excited because I have with us, all the way from Minnesota, connecting with us, Dr. Dileep Rao. He is a Forbes contributor and entrepreneurship researcher with deep experience across venture capital, debt, and alternative financing. He has written about venture and growth financing for organizations including the New York Times and the American Management Association. He focuses on helping founders build durable companies without losing control. So, once again, thank you, Dr. Dileep Rao, for joining us in this insightful and enriching conversation. And the main topic we're going to be talking about today is unicorn entrepreneurship. Dr. Rao, please.
Thank you for inviting me, Susanna. And just so that all of you know, Susanna was one of my best students. And so this is a special pleasure to join her on this show. I was a venture capitalist for a long time, for about 24 years, and also a financier because we wanted to make sure that we helped all kinds of companies, not just those that qualified for venture capital. So we had loan funds, investment banking, leasing, industrial real estate, and we built a company from 500,000 in assets to about 80 million. And that's when I retired. And then I had a PhD. So I joined a university and started teaching at Minnesota, where I live, and found out a very interesting fact. And that is, I used to invite speakers to my class, and these are some famous people, such as the founder of Medtronic, the founder of Best Buy, the founder of United Healthcare. And what I found is that many of them had not used venture capital. And my assumption, like many, is that the sun rises and sets on venture capital and the venture capitalists, that without venture capital, nobody could build a major business. So I decided to find out how many others there were who had built very successful companies in Minnesota and around the country. And I found that I had funded 9 companies that became either 100 to $99 million companies or 1 billion and up. And one of them was Sam Walton. In Minnesota, I found 28 entrepreneurs, and only one had followed the traditional venture capital route of getting venture capital early. The rest had basically avoided or delayed venture capital in order to keep control. And that is a key difference. So I looked around the country and I found 87 billion-dollar entrepreneurs and 3,600 million-dollar entrepreneurs. And I basically had financed 9 of them, interviewed about 37 so far, and the rest I studied. It's a little difficult to interview people like Steve Jobs since he had died, uh, but he's a great example. And so the point I want to make is that out of the $87 billion entrepreneurs, 94% of them kept control. Only 6% lost control. And this told me a whole bunch. And that's why I wanted to study more about how they did it. And what it told me is that if entrepreneurs keep control of their ventures, they have a much better chance of succeeding than if they give up control. So this is not an anti-venture capital argument, because having been a VC, I know the importance of VC, especially where it can help you accelerate faster than your competitors. But it's an argument with backup proof. Go to my website, which is my name, dileeprao.com, or look at my blogs on Forbes. I've been writing blogs on Forbes for about 14 years, and they all talk about how great entrepreneurs succeeded because they kept control, which means they keep control even over the venture capitalists. They do not lose control to the venture capitalists either, because they and the venture capitalists have 2 opposing goals. And that's very important to understand. So my books And what I teach, I taught in Argentina as a Fulbright. I'm going to Poland in April and hopefully to Nigeria. And I'm trying to spread the word that it's control and skills that help entrepreneurs succeed. And there are many people, especially the VCs, who stand to gain, who will put you down as an entrepreneur. They will tell you you're not qualified. They will tell you you don't have skills. But the reality is, by keeping control, you can tell them where to go. And that is the key point.
Excellent. Thank you for sharing and for taking your time to spread the word. So I'm very excited that I have you here with us because I really want to expand your knowledge, especially in Bahrain and in GCC. Based on your years of experience, have you seen a shift in that mentality? Because I know you've been talking about, I have read your books and your articles. Have you seen the shift in mentality here in the United States or compared to Argentina? Could you explain a little bit and elaborate a little bit more about that throughout the years? What changes have you seen in regards to that perspective?
Well, I have seen a shift because I think people have begun to realize the shortcomings of venture capital. And when I say shortcomings, it's quite simple. If you read it and if you go to my website, there's a book called The Truth About Venture Capital. It's free to download. Anybody can download it. But essentially, the reality is, when do venture capitalists fund you? Many people think because of pitch competitions that venture capitalists can listen to a pitch and tell you who's going to succeed. They cannot.
Right.
Even Steve Jobs, perhaps the greatest entrepreneur of the last 50 years, or one of two, Elon Musk is up there, was rejected by 10 of the greatest VCs in Silicon Valley. Google was rejected by 12 VCs in Silicon Valley. What it points out is that no one can tell which company and which entrepreneur will succeed. And that is the first takeaway, that don't let anybody else tell you that you're going to succeed or not going to succeed because they say, oh, I can look into your eyes. That's not true. If that were the case, they would have funded Steve Jobs.
Right. Yeah,
So
it's not true. Not in business, not in love. You cannot see through the people's eyes. I don't know where they got that from.
in my case, I saw my wife's eyes and I decided that she's the one I'm going to marry.
Oh
So,
my goodness.
so
So you were
uh,
a venture capitalist on that end of the story.
but the other point is that venture capitalists finance about 100 out of 100,000 ventures, only 100. So they're very selective and they wait for what I call aha. I don't know if you invest in the stock market, but when you say, damn, I should have invested in that stock, and that's immediately after the stock took off. That's
Right.
aha. It's when you can see potential. There are some signs where you can see potential, and VCs wait for that. The first potential is technology aha. It's not the pitch, it's a technology. And in my sample of $87 billion entrepreneurs, only one got VC after the technology. And that was a company called Genentech. And Genentech started the whole field of biotechnology because one of the scientists, spliced the gene. It is as great a technology as if somebody cured cancer today. And that company was given venture capital because of that breakthrough. 5% succeeded because the entrepreneur actually launched the venture. The entrepreneur either didn't want to run the venture or didn't have the skills and didn't want to learn. And eBay is one of them. And the entrepreneur was shifted aside. So the second is when VCs see the strategy, and I call it strategy aha. The third is when VCs see the strategy and the entrepreneur skills. Mark Zuckerberg is a great example. Bill Gates is another great example. Jeff Bezos is a third example. And what they did is they not only launched their venture in a high potential industry, but they also showed the skills and the confidence to lead that industry. And that's when the VCs came to them They didn't have to pitch anyone. They didn't have to plead to anyone. They didn't have to beg for VC. The VCs came to them and basically said, we want to fund you. Peter Thiel, who's one of the great VCs of our age, flew from Silicon Valley to Boston and told Mark Zuckerberg, I want to fund you. Come on over to Silicon Valley. And that's when Mark Zuckerberg went. So they come to you, even across the country. So you don't have to go to a pitch competition. The reality is no one can listen to a pitch and predict that you will succeed. And if anybody claims to do it, tell them, look, you want to be a judge in a pitch competition? Fine. You pick the winner and you have to invest $1 million in that winner and see if they have the guts to be a judge. Because what they'll admit to is that they don't know. They're just guessing on who looks good, who presents well, who speaks well, has nothing to do with success. And the fourth aha is someone who has already built a technology, a unicorn. And that's someone like Elon Musk today. Or if Bill Gates starts something, or Mark Zuckerberg starts something, people will flood them with money. So those are the four ahas. And so that's the second point. VCs wait for that, which means you, the entrepreneur, have to bridge that gap from the startup idea till aha. You need skills. You need to prove your potential. The third fact about VC is that VCs have succeeded mainly, I'm not saying only, there have been rare exceptions somewhere else, but mainly in Silicon Valley. I'm talking about the US. They have not succeeded anywhere else as well. And to give you an example, Mark Andreessen is a successful entrepreneur. VCs fail on 80% of their ventures. They actually fail on 80% of their ventures. Only 20% are successful. And this is in Silicon Valley, among the best ones. And out of that, one becomes a home run. Now ask yourself, if you're the entrepreneur, a simple question. If these people were such experts, and that includes me, okay, so I'm not removing that. But if these people were such experts, why did they fail 4 out of 5 times? And how do I know that I'm not going to be one of those 4? So do I want to give control of my venture, I'm coming back to control, to these people who fail 4 out of 5 times? Now, sometimes they fail not because they're incompetent, but because that's the nature of the race. It's like the Olympics 100 meters. 10 people enter or 11 people enter, I think it's 10, one wins. It's the same thing in venture capital. They invest in emerging trends, not everybody wins. There are many failures. But this is the interesting point. Only about 15 to 20 venture capitalists earn 95% of venture capital profits. 15 to 20 venture capitalists. There are about 1,000 VCs in the country. If you take money from the other VCs, you're most likely to fail. And you're most likely to give them control and then fail. So my thesis is very simple. Based on these facts, if an entrepreneur wants to build a major venture and become a unicorn entrepreneur, they have to control their venture so that their fate is not in somebody else's hands. They have to get the skills and they have to know the process. If you as an entrepreneur cannot do all three, then go to a VC and pray to your God.
I think it's up to the students at the end of the day to find their own knowledge, right? Because as a student, okay, you get different professors, but then they're just there in a way to guide you and to have you question or agree or whatever. So I had seen that it's not just in the US, but also overseas, the ecosystem of entrepreneurship, it really comes down to pitch competitions the most. Yes, they might train you for maybe 4 weeks, 6 weeks, but at the end of the day, I had noticed and seen, not just in the Middle East, but also in Latin America, that at the end of the 6 week training program as an entrepreneur, the main event is a pitch competition. What do you believe, or what would you suggest to the ecosystem to create? Because change takes some time, and sometimes you have to create something similar to it and then keep pushing it to embrace it. What would you suggest to these entrepreneurship ecosystems and business incubators to create instead of a pitch competition if they still want to have that event of the day, you know?
I used to teach at Minnesota, and I kept pointing out the University of Minnesota has a pitch competition, and I kept telling people that this is not the right way. And after 2 years of trying to tell them that, I quit. Uh, so, and I'm teaching in Florida, and unfortunately, Florida seems to be going in the same direction. So, pitch competitions are a disease, I think, in business schools because it's glamorous, it raises money. Many sponsors want to give money to promote their, especially people like banks. And it's a lot of circus. It's a beauty pageant without a skills aspect. So having given you my perspective on pitch competitions, and as I said before, if somebody's that confident about listening to a pitch and picking a winner, they should take the entire net worth and invest in that venture. And that shows you, and every judge of every pitch competition should invest their entire net worth in the winner, the ones that they picked as a winner. And that to me would be at least somebody putting their money where their mouth is. But to me, what's surprising is that business schools are following it without any research that people have the instinct to pick winners, especially when 10 VCs rejected Steve Jobs. Going to what should replace it? I've been proposing a skills competition, but a skills competition is a lot of work, and it's much more work than a pitch competition. So deans and other officials of business schools would rather do a pitch competition, quick and dirty, get some money, get some recognition, and move on, as opposed to actually doing something meaningful. So I know I'm castigating the business school ecosystem and the incubator ecosystem. And you can ask me later why it happened this way. I can tell you. But what I'm suggesting is that we replace a pitch competition with a skills competition. And a
I like the
skills
sound of it.
and the skills competition is very simple. It goes to the basic assumption that nobody can look into somebody's eyes and predict a winner. And so what it does, and I suggested this in Argentina, they haven't followed it up because there was a guy from Stanford supposedly the year before, and he had talked about pitch competitions. I have no idea if that's true or not, but that's my assumption. And I'm going to propose this in Poland. But you start with an introductory webinar, and I do this around the world now. You do an introductory webinar. It's a 1.5 hour thing that basically points out the difference between venture capital and unicorn entrepreneurship. And it says, this is what venture capital does. Go and check it for yourself. You don't have to take my word for it. And this is what unicorn entrepreneurship, here are the names, here are the people, here's what they did. Go and check it out. Do your own work. I've got 2 books on unicorn entrepreneurship that people can buy and read. And the 2 books are behind me somewhere here. But the point is, so you first have the introductory workshop pointing out the two paths. And as I said before, 94% became successful because they followed the unicorn entrepreneurship path. Now they didn't study with me, okay? I studied them, so that's the difference. And once you have the introductory workshop, then I have a 10 seminar or 10 webinar program where I teach people the business strategies of unicorn entrepreneurs, the finance strategies of unicorn entrepreneurs, and how to develop their business plan based on that. Then the third step is a skills competition. That's essentially saying, we're not going to give you a dime. We're not going to give you any money. You're not going to come and act like a beauty pageant winner and give us a pitch, because I have no clue who's going to win and who's going to lose. And if any VC thinks that they can do it, why do they fail on 80% of their deals after the venture has proved some potential? But what you are going to do if you want to be part of this is to raise money on your own. We've taught you how to do it. We've taught you to fish. Go and catch some fish. So you raise money on your own. We'll introduce you to the finance network in this area. You raise money on your own. You show us how much you can grow with how little capital. So the skills you have to prove is within a year. How much have you grown with how little capital? If you have grown the most with the least, you won the skills competition. If you raise a lot but didn't do well, you don't win the pitch competition. The pitch competition is not about those who raise the money, but those who use the money well. That's a skills
I see.
competition. And my reaction is, even if you don't build billion-dollar companies, but you train 100 entrepreneurs in your area, and 20 of them build $1 million business in 2 or 3 years, that's 20 million additional that you actually have in your ecosystem. And one of them might build $100 million business or $1 billion business. That's the beauty of it. Once they get started, they can take off on their own. But if they want some assistance or help, what I found is that the best mentors are not older people like me, but co-entrepreneurs. I've done that in the past when I was a financier. I used to organize circles where entrepreneurs advised each other. The reason that, and that's what I suggest for this too. The reason is my experience. I started in this business in 1973 when I was 2 years old. Okay, I'm just kidding. Uh, but I started in 1973. So it's been about, what, 52 years? God, time flies while they're having fun.
Yeah.
So it's been a long time. And I learned a long time ago that my skill sets are limited. Everybody's skill sets are limited. How much I mentor someone, I'm giving them my biases. And some of them think I'm experienced, so they should follow me. And I realized, so it's better, I found, if they advise each other because they're all going through the same trend and the same situation. Why is that important? This is a fundamental lesson that I think everybody should learn. If you want to build a big business, if you want to build $100 million company or $1 billion company or whatever, depending on where you are in the world, it is easier to do it in an emerging trend. 100% of the billion-dollar entrepreneurs I've financed or studied, 100% succeeded on an emerging trend. Now, why do I emphasize the 100%? Because there are no 100% rules in business. And I'm trying to find exceptions to this. And I haven't yet. But those who built a big business, like Sam Walton in the 1960s, Bill Gates in the 70s, Steve Jobs in the 70s, Michael Dell in the 80s, uh, Google in the 90s, Jeff Bezos in the 90s, Airbnb in the noughts. Everyone built on an emerging trend. So the skill sets you need if you're going to succeed, and this is what universities should be teaching, what business schools should be teaching. They should be working with the other schools in the university. They should be teaching emerging trends, skills in emerging trends, skills in emerging technologies, along with the business skills to build a successful business on the emerging trend. So ask yourself this question: why did a 19-year-old Bill Gates succeed? Why did a 19-year-old Mark Zuckerberg succeed, beating Rupert Murdoch? Why did a 18-year-old Michael Dell succeed? They all started on emerging trends. And what that does in an emerging trend is there are no established experts. And so gray hair doesn't mean anything. Somebody who's 40 years old doesn't mean anything. A PC, a personal computer, nobody knew how to run personal computers when Bill Gates got into it.
Right.
So he had an advantage. Nobody knew much about the internet. When Jeff Bezos got in, when Google got in, they had an advantage. So emerging trends basically create new opportunities where the establishment, the established world has no advantage. And if the emerging trend is built by what I call a revolutionary technology, which can destroy the old, like the internet, that's a double advantage. Now, AI is not a disruptive trend in that sense. It's not a revolutionary trend. Existing companies can easily use it. But even here, what you're seeing is many entrepreneurs have started ventures in AI.
Yes.
And
Now it's like everywhere.
exactly. But they're competing with the Microsofts and they're competing with the Googles. And what you'll see in the next year is that they're going to start to sell to these companies, especially when the funding dries out a little. Mark Zuckerberg has spent a ton of money on AI. He hasn't succeeded yet, but his strategy has always been to buy out other companies and add it to Meta. And he's going to do it. So will Microsoft. So will Google. So you're seeing Google get into AI and start to destroy ChatGPT. Well, I shouldn't say destroy, start to disrupt ChatGPT because they can. That's the difference between revolutionary technology and evolutionary technology. So venture development, especially at the high level, is not as simple as doing a pitch competition. The unfortunate part about entrepreneurial education in business schools, because I was there at the start, is that entrepreneurial education started in business schools about the same time venture capital took off. Venture capital took off when legislation changed, and this was in the early to mid 80s. And business schools started teaching entrepreneurship. Before that they called it small business, and they had one class. And I asked my advisor, I, I was always interested in entrepreneurship. I called it, I'd like to take the small business class. Do we have any? He said, no, vocational schools teach that. Maybe you should join a vocational school. I've never forgotten that insult. But the point is, entrepreneurship started in business schools around the same time, and they all assumed, because it started in Boston, they all assumed that the way to do it is the venture capital method. Because I knew some of the early leaders, and they were in Boston, and they were affiliated with some venture capital groups. They were trying to do some research and consult, and they tried to consult with me, and I said no. But they were focused on venture capital, and because of that, that influence spread. So it's an unfortunate part of timing, and I'm hoping to change that.
I'm looking forward to it. Dr. Rao, when it comes to angel investors, could you tell me a little bit more about when is the right time for an entrepreneur to look for angel investors?
That's actually a very interesting and nuanced question. And the reason is, should an entrepreneur raise money from one angel or multiple angels? Okay. So not all angels are created alike. And so I usually advise entrepreneurs to go after multiple angels. Because if you go after one, you are at a very early stage. That angel has a lot of money. They have succeeded at something in order to make money, or they've inherited the silver spoon. Many people who've inherited money become angels. So they haven't built a company, but they have money. But even if they are an entrepreneur, they like to dictate. They like to tell the entrepreneur what to do, even if they don't know much about the entrepreneur's industry. That's the first part. And really, nobody knows how to succeed in a new emerging industry. Nobody could have guessed with Sam Walton that the best strategy to succeed in big box retail was to build it in small towns. And we funded his stores in small towns. And that's where Kmart couldn't come and destroy him, but he could go to big cities and destroy Kmart. Nobody knew in personal computers that the key strategy was to control the operating system. Bill Gates did that and beat IBM. And think of this. If IBM knew that, why wouldn't they have an option to purchase Microsoft so that they weren't beaten in personal computers by Microsoft? And this goes on and on and on. Nobody knows the right strategy. And so if an angel dictates to an entrepreneur because they are experienced or it's their money, then the venture fails. So if the entrepreneur wants to succeed, they have to learn how to do it. They have to learn how to test their assumptions. They have to learn how to find the right strategy, which means they have to be able to pivot. They have to be able to test different things. The best way to do it is to get multiple angels, is to get many angels, none of whom are investing a whole bunch. But this means more work for the entrepreneurs, and many entrepreneurs take the easy way out and pay the price. But if they get multiple angels, then they have the choice of picking multiple brains, then picking out the best solution from those multiple advice, and then testing it with the freedom to control. If you notice, I keep going back to the word control. So at the end of the day, if the entrepreneur wants to build a big business, they have to control so they can adjust with the data. If I have to go to a board of directors of advisors, VCs, and angels every time I need to change something, my competitors might go faster than me because I'm getting the data and to sell to them while an entrepreneur who doesn't have to convince their board has a 2 month advantage. So that's why control becomes so important. And the entrepreneurs can then decide what they want to do. But this is where angels, if they invest a whole bunch of money, they want to control it. But if they invest very little money, I just agreed to invest some money in one of my former students' ventures. And this is an exception because I don't invest anymore. My last investment was 10 years ago, and I just sold it last year for about 20 times. It's not bad. But anyway, I invested in him because he's the second smartest entrepreneur that I've encountered as a student.
It was the skills that convince you and the data, not the look in his eyes.
He has a skill set. He's proven it. He has the technical skills. He has a character. And most importantly, he's determined. I've seen him now for about 10, 15 years, and he doesn't take no for an answer. He studies things. He does it. I'm very impressed.
What's the feel of that investment, the entrepreneurship?
He's starting an angel fund, actually. He's starting an on. He has started, and he's developed an instrument called Safer for instrument for angels, because there's an instrument that Silicon Valley has developed called Safe, which is really crap. And if anybody who's listening to this wants to know why, to me. But when I was in Argentina, they were using Safe, and I hope I convinced them not to use it. But Safer has taken care of the shortcomings of Safe, the financial instrument. And so I like the fact that he designed it and developed it. And so it's a way to build many new ventures. So he helps entrepreneurs find angels, actually. So your question is
Good.
very true. He is actually doing exactly that. And I feel that's a need. And so I want to help him.
Perfect. I like the mission that you are on, because aside from sharing your knowledge, you're also willing or are doing it, investing on something that it's aligned to your belief. And even though you stop investing, you decided to go for it. So I'm looking forward to see the success.
Feel I'm blessed. I went to Mississippi, to a very poor village, and I was a consultant to the U.S. Department of Health and Human Services, and I went to a poor village, and they were trying to build a business with government help. So I went there to advise them. But that village was built on stilts, and the reason they were built on stilts was because they were in the floodplain of the Mississippi River. So when the Mississippi River floods in the spring, supposedly there's water there. So they are above the waterline. So think about the poverty level in that. And when I met the minister who was head of the development corporation, I said, "How are you doing?" He said, "Blessed and highly favored." And my reaction was, if you think you're blessed and highly favored in this village, none of the rest of us should ever complain about how much money or how little money we have. But I do feel that I've been blessed. And so I want to do whatever I can.
Perfect. Dr. Rao, could you please let me know, what would you tell an entrepreneur that is just starting, like from zero? Because I know you mentioned how important skills are, and that a lot of the schools nowadays, they don't offer the right path in some way or another. So what's something that you would tell them aside from reaching out to you?
Well, I think the key question is, why do people become entrepreneurs? And often what I have seen is that many people become entrepreneurs to improve their lives. And some do it even though they've been born to rich parents because they want to make more money. But the key question that I ask them is, do you have the skill sets to do what you want to do? And so the advice I would give everybody is understand the skill sets that you need and understand your strategy. I have developed an AI-based platform that essentially takes anybody's executive summary. If I feed a 2-page executive summary into this, it gives the entrepreneur an analysis of their business plan based on 28, I think it's 28 criteria that were used by the billion-dollar entrepreneurs. So the analysis is easy with this. and it does very good work. I've been checking it out. Uh, so analyzing anybody's executive summary can be done. I just did it for somebody in Nigeria, and he's implementing it. So good for him. But the other side are skill sets, and the skill sets are tougher to learn. So there are three sets. First set is startup skill sets. And for startup, what I found that and these are all based on the skill sets that these entrepreneurs had. In many cases, the interviews I had, in some cases, I worked with some of them when I funded them. But the first skill set for startup is they all had the technical skills in the industry they went into. So if they went into software, they knew how to write software. Steve Jobs had some skills in emerging trends, but he got a partner called Steve Wozniak, who knew how to build computers. But Steve knew enough about it, so he knew how to design it and how to market it. So technical skills in emerging trends. And this is why I want business schools to work with technical schools, because that's where the products are developed. The second is sales skills, because if you don't know how to sell, you don't get your business started. So you need to learn sales skills, and especially to sell for its true value, which means you need to be able to develop value, and you need to know how to sell value so you can charge more. Steve Jobs was the greatest at selling value. The third skill set is what I call bootstrap finance skill sets, not bootstrap financing, but bootstrap finance, which means what business schools teach people is corporate finance. So the finance class is basically in the corporate finance department. Most of them have no clue about entrepreneurial finance. The difference is this: corporate finance teaches you how to allocate money that you have, because corporations have money and they're trying to decide how to allocate it. That's why the net present value, IRR, all those calculations. How do you ration? Entrepreneurial finance is how to allocate finance with money you don't have. Okay. So corporations have the money, entrepreneurs don't have the money. Yet entrepreneurs need to allocate it. So how do you allocate it? This is investing the money. Where do you invest the money? Because every entrepreneur who succeeded in this group had one key advantage. So it was like, if I go to war, I have one weapon, attacking weapon, that can destroy the enemy. But at the same time, I can't leave myself open to the enemy destroying me. So where do I invest in the attacking weapon? That's the bootstrap finance. Where do I invest to kill the enemy? And where do I invest so that I'm not killed? Okay. So that's bootstrap. The second step of the group of skills is, how do you launch the venture? Launching the venture involves bootstrap financing. This is raising money when nobody loves you. And there's a famous song by B.B. King called "No One Loves You But Your Mama." And she could be jiving too. Okay. Which means even your family may not fund you. And I've seen that happen. And my rule right now is, if your family doesn't fund you, I don't fund you. Uh, And I think because your family knows you better than I ever will. I learned that from one failure I had. But the point is, how do you raise money when nobody wants to fund you? Second, how do you operate when you don't have money? That's bootstrap operations. Third, how do you take off without money? That's launching skills, which means that taking off means that you need to know where to fund, what sales driver, how do you sell, how do you get money? Michael Dell is a genius at this. When he started Dell, he started selling to his fellow students at the University of Texas. And he put flyers out, I think, and advertised in the school newspaper. And word of mouth. Same thing with Mark Zuckerberg. Started at Harvard. So these people knew how to sell without money, without capital. Because if I ask an entrepreneur, how many sales drivers do you use? And if they give me more than one, I know that this person has no clue what he or she is doing. Okay. They don't have to say much more. After that, it's just I ask a few questions and say,
Wow.
I'll get back to you. But I've already decided not to fund them because if they're good, they will tell you this is the best sales driver because it addresses my key market segment and it addresses my key competitive advantage and the product advantage. And I've tested it and I know that I can get sales. That's what I call the strategic fit. I'm writing a blog on that in about 2 weeks, so you should tell everybody to read it in Forbes.
I'll make sure I'll share it.
The strategic fit. And basically what I'm saying is that the product market combination essentially starts your venture. The strategic fit helps you succeed and kill all the companies with the product market fit. Venture development is not just about finding a customer, it's about beating your competition because there are many companies going after the same prize in the emerging industry. So those are the three skill sets to launch. After that, some entrepreneurs basically stay where they are because their skill sets are limited, but some other entrepreneurs want to become billion-dollar companies. To become a billion-dollar company, you need three skill sets to grow. One is control. You need to know how to control your venture from a small venture to a large corporation. Otherwise, you fail, you're kicked out, somebody kicks you out. Second, you need to build a great organization. How do you recruit people? How do you train people? How do you motivate people? How do you make them work in the same direction? How do you reward people? Because at the end of the day, we don't work for somebody else, we work for ourselves. Somebody else just makes it happen. And the great entrepreneurs realize that. So, how do you organize? And the last is how do you become a great leader? How do you grow from this entrepreneur who started a venture to a Jeff Bezos, to an Elon Musk, to a Michael Dell, to a Bill Gates, to a Steve Jobs? How do you get there? What do you have to go through? And there's a great, okay, I keep saying it's an Arab proverb. And since you are going to be showing it in Bahrain, you should know it. But when I talk to Arabs, none of them ever heard it. Okay. But in the West, it's like all the Chinese proverbs, nobody in China has ever heard it.
I think it happens around the world.
But this Arab proverb is one of the great ones about leadership. And what it says, supposedly, is lions led by sheep will lose to sheep led by a lion. Just think about that. Lions led by sheep. So your people might be great, but if you are not a great leader, you will lose to sheep led by lions. It's the importance of the leader. And you see it again and again and again. And so those are the 9 skill sets that I'm trying to teach.
Perfect. Thank you so much. I wanted to ask you for students or universities that are interested in any of your webinars, how can they reach out to you? Through LinkedIn, your website, and email? What would you like me to provide? And first of all, are you open to that?
Well, if they have 30 to 40 students, yes, I teach the introductory workshop or webinar for free. After that, if the university still wants to do something, I need to talk to the university.
Okay, perfect.
But the introductory webinar I give for free. If an individual student wants to do it, then I usually collect a whole bunch of names and then I offer it.
Okay, so that means if I'm able to get 40 students from different universities from Bahrain and Saudi, we'll be able to host a webinar.
Exactly. We'll do a webinar, we'll talk about this, and then if they want to do it further, we can develop a unicorn entrepreneur ecosystem in Bahrain.
Oh, how wonderful. Yes. Right now, actually, they have just announced Capital Manama, the youth entrepreneurship hub. I guess that's the word.
Tell them to watch this video before they go off in the direction of a pitch competition.
We're going to have a skill competition. I love it.
We'll have a skills competition, exactly.
So we need to come up with a better name than Shark Tank for the skills competition.
Yeah, basically, it's a skills area.
Exactly. Well, Dr. Rao, I want to thank you for your time, for your knowledge. Anything else you would like to share with us?
I'm impressed with what you're doing.
Oh, thank you.
And hope you do more of it, and I hope you get all the success that you deserve.
Thank you. My mission is like yours as well, to share knowledge and make sure that everybody has the same opportunity to learn and decide which route they want to go. But at least the resources are here. And I look forward to unite the Middle East with the US. As you mentioned, it is important as entrepreneurs to share their own stories because that's how we learn the most. And
Most
work with people.
importantly, unicorn entrepreneurs are the ones who develop an economy, especially economies that don't have natural resources. And so you need unicorn entrepreneurs to build companies that can export to other regions and bring in wealth.
Perfect. I'm looking forward for great things. And who knows, you might be heading to Bahrain. All right,
Thank you.
Dr. Rao. Thank you
Thank
so
you,
much
Suzanne.
and a pleasure. Thank you so much.
Thank you.